We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Brady, former money manager, Sprott Money, and silverchartist.com contributor, and an expert on all things gold and silver. Welcome back, David. It's been a long time since we've spoken.
Excellent, Tom. Thanks for having me.
Great to have you back, and looking forward to really digging into everything with you here today. So, since the last time we spoke, we've seen the Fed start to raise rates, market volatility dramatically increase, gold stay, relatively range bound, and oil break much higher. So, of course, we've had the war in Ukraine break out and seen more lockdowns in China. So there's all these things that we've seen since the last time you and I spoke about. So why don't we start by kind of getting your 5,000 foot view of what matters to you right now?
My primary focus is the Fed. It's that simple. If you think about going back to our last call, which was in July of 2020, almost 2 years ago now. And back then, and by the way, fantastic podcast. I mean, it was memorable because I got so much feedback, positive and negative. But if you go back to that one, I made a prediction that the gold and silver, which gold was booming at that point, were about to peak. And I specifically stated that it was going to happen in August. And why am I bringing all this up? Because of the reasons why I called for the peak. The Fed was printing money since the repo crisis in March 2020. Trillions, I thought it was 3, now I learned it's 6 trillion, to prop up the markets and so forth. And prior to that, I knew I posted an article on Sprott back on March 5th, stating that when they return to QE, gold and silver are going to skyrocket. And that's exactly what happened. We went to record highs. But I said on our podcast that the reason that I expected gold and silver to peak was because the Fed in July had just cut QE by 88%, from $1 trillion per month to 120 billion per month. But on August 1st, the checks being sent out to Americans were due to expire. And many people expected that it would be extended. It wasn't. And I saw that was probably the most likely outcome, that they would let them expire. So you take away the monetary stimulus and the fiscal stimulus. What happened next? Gold peaked, and now we're nearly 2 years later, and we're in the mid 1800s, but we've tested those highs almost recently, but we haven't gone up to new record highs. We've been going sideways, as you pointed out. And the reason for that is that, and why we've come off recently, is the Fed has followed through not only on its taper comments, but on high increasing interest rates. Why? Because inflation turned out not to be transitory and they needed to bring it down. That's a whole other conversation. But to answer your question, it's the Fed. Because when the Fed does an about turn, and in my opinion, they'll do another 180, just like they did in December of 2018. When that happens, gold and silver are going to skyrocket, just like it did post-March 2020. And I actually think the rally this time around will be even bigger. I think the first one was a preview. I think the next one is going to be the main event. So that's what I'm focused on. I'll stop here, but I'll just say that there are numerous signals that I am looking at to suggest that the Fed is going to reverse course. You can either try and get ahead of that, if you start hearing them start to become a little bit more dovish and so forth, or you can wait till the actual event. But I believe it's coming for numerous reasons, and there's, we can talk about history to justify that belief, because any time in history that countries have gone into debt issues, and this is a debt crisis, sovereign debt crisis, they never default. They always choose to inflate the currency, to inflate the debt away, devalue the currency. Why would we think they would do anything different this time around? So that's my primary focus. And people can debate this, but from my perspective, the markets are essentially managed. And why is that important? Because if markets are centrally managed, then all of the assets that you mentioned, be it currency, bonds, stocks, oil, commodities in general, gold and silver, they all come back to the central banks and, on a fiscal side, the government. Unfortunately, they're not free markets. Well, when I hear about, capitalism needs to be, we need a better system. This isn't capitalism. My definition of capitalism is free markets, truly free markets. It's like you and me getting together, and I've got a potato and you have an egg, and we decide how much we're going to pay each other for. It's not somebody else telling us how much it's going to cost. So that's why the Fed, especially right now, with increasing government and then central banks all over the world having a bigger impact on markets because of all the intervention they've been doing. Trillions. If you stacked $1 trillion on top of one another flat, you could walk to the moon. 1 trillion. Just to put it in perspective.
Yeah, I remember interviewing Mark Yusko a long time ago, and he said, just to give another frame of reference for how big $1 trillion is, that's like spending $1 per second for 31,710 years.
Yes.
Right? It's unbelievable. It's inconceivable how much a trillion is. And as you pointed out, we just printed 6 of them.
If you say the same thing over and over again, just like lies, use the word trillion over and over, people become numb to it. But when people put it in perspective for you, like, wait, what? Yes, these are enormous numbers. And we did 6 trillion last time around. I think it's a safe bet on the next one, 10 trillion.
So, just stepping back, let's say from the next time that they dump a bunch of stimulus into the markets, how are they justifying, let's say, raising rates right now when the economic indicators are flashing recession? Is causing a recession the only way that they have to really help curb inflation?
Pretty much. I believe they're trying to engineer a mini recession to get inflation down. And one of the reasons for that is a lot of this inflation, and this goes back, I made these comments back in 2020 as well. We have supply chain issues in a big way. And if you have supply chain issues at the same time, there's higher unemployment. Now, I don't take the unemployment numbers that were given on face value, because if you look at the total adult working population in the US and you look at the labor participation rate, unemployment is far higher than we're being told. And so if you've got less demand, and we know there's less demand because you're seeing credit cards being maxed out. All the stimulus that was provided to Americans are gone. A lot of people have been made unemployed. Their businesses are gone. And what kept them going was all this money being printed. Well, that's been taken away now. So now they're maxing out their credit cards. They're drawing down on their savings. So demand is starting to drop off. The only things that that is left for them, that's possible for them to buy and they need, is the necessities like food, electricity, and so forth. So all of the consumer discretionary products, I mean, who's buying Gucci ties now? Only the well-heeled. But so you've got demand coming off. Meanwhile, supply is coming off. So that is now going forward. That's why I think we're going to see disinflation, not necessarily deflation, disinflation. You're already starting to see inflation fall. But when we had that period, and let's be clear, money printing and is in 2020 was happening real time. But the effects of that money printing doesn't felt until years later, maybe couple, maybe 5, maybe 6. They printed a ton of money during the 1960s in the US. And there was inflation, but it wasn't dramatic. What happened in the 1970s? It took, there was a lag period of 5 to 10 years before all that money printing uh, became apparent. The effects of it became apparent in the 1970s. Well, it was a lot faster now because there's a lot more intervention in the market on a more frequent basis in bigger size, trillions. So all of this waterfall of money, this waterfall of currency, as Mike Maloney prefers to say, hit the markets in 2020. Then they tapered it off in July of 2020 and kept it going on. And now they're talking about cutting the balance sheet, and now they are raising rates. So you had all that inflation was driven by all this money chasing fewer and fewer goods. Remember in March 2020, gold and silver hit a bottom, and then they came out printing the trillions and so forth. Well, do you remember what happened to premiums, physical gold and silver? They skyrocketed. Why? Well, because demand went up. But the gold refineries in Switzerland were shut down because of COVID. So my point is, you shut down supply. Meanwhile, demand just soars. What happens to price? Look at the price of everything right now: housing, oil, food. I mean, I could go on, but everything going up together in price is not driven by a supply-demand equation. It's driven primarily by more money chasing either the same amount or fewer goods. I mean, there could maybe even more goods and services, but the rate of increase of those goods and services pales in comparison to the increase in the money supply. I mean, this isn't rocket science. If you've got 2 cans of Coke and you've got $2, well, how much is a can of Coke? $1. Now you have, say, $4. How much is each can of Coke? $2 each. Take 1 can of Coke away. How much is a can of Coke now? $4. The point is, if you print more money and at the same time there's less goods and services available, whether due to lockdowns or due to port restrictions or whatever it is, the price goes up. This is economics 101. So the only way, coming back to your question, that the Fed could address this, because it's a supply chain issue mixed with money printing, is that they can cut back money printing. But they also, which obviously helps the situation, but again, it's a lagged effect. So they need to come down now. So what do? They have to crush or slow demand. And the only way to do that is to cause a mini recession, because they can't control the supply side. That's geopolitical. I mean, Ukraine is a perfect example of that. But can they cause a recession? Yes. I mean, the markets, I don't want to be too long-winded on this, but let's take the stock market for an example. Since 2008, the stock market has been propped up, in my opinion, by easy money. And essentially, it's a Ponzi scheme. Now, with any Ponzi scheme, the inflows into that scheme have to be continuously rising. If they stay stable or fall, given the cash outflows they have to pay to the investors, it collapses. Well, what do you think is going to happen to the stock market if the Fed pulls back on QE and raises interest rates? If you want to know, just look at the stock market since November. The NASDAQ and the S&P. There it is. So they know, and as Luke Groman said, and he's right, the stock market now is the economy. GDP relative stock market capitalization, the stock market rules the economy. The stock market falls, the economy, it's the tail's wagging the dog. So they know that if they cause the stocks to fall, the economy's going slow. Hey, presto, inflation starts to go down.
So, David, when we're thinking about how, let's say, this disinflation happens, while relative price levels can actually stay at the same levels, that year-over-year comparison is going to come off, because if prices aren't rising as the comparison to last year, that makes it look like the cause of inflation is maybe being stemmed. Is that fair?
Yeah. Well, the
Or are
cause
you
of
saying
inflation,
that
again, there's many causes to inflation. You got a demand side and you got a supply side. They can't control the supply side, but they can control the demand side. So that, yes, in terms of demand side, they're addressing that cause. You're not giving out money to everybody and have at it, enjoy yourselves, go on that vacation, buy those Gucci belts, whatever. But they can't control that side, but they can't control the supply side. That's geopolitical. And so to answer your question, yes and no. Yes on the demand side, no on the supply side.
So considering this inflationary environment that we are currently experiencing, and the fact that we're really not seeing wage growth account for debasement of people's purchasing power, is this the stagflationary environment that you were predicting that we talked about back then?
Yeah. This is stagflation. You've got the economy's going one direction. Well, actually, we've had it. Now stagflation is coming off because the inflation component is starting to fall. We just got a lower number last month. It was funny, actually, just quick aside. People focus on the expectations number. Don't get caught up in the expectations game. Yeah, it does justify market moves, at least as a catalyst for it. What I looked at was, what was it last month and what was it this month? It went down. Nobody seemed to focus on that. It came out higher than the expectation. We can't we can't go dovish again, says the Fed. Well, actually, inflation's falling. It's already started. And that's across the CPI, PPI, and the PCE. And I expect that to continue. But the risk that the Fed runs into here is they're using, as I said, they're causing a mini recession. Yet they say the economy is great, but the GDP numbers in Q1 were awful. And it looks like GDP in Q2 is going to be negative too. That's a definition of a recession. But they're saying the economies were great, hence the economy and the markets can withstand our tightening policies. So unfortunately, for the Fed, at some point, they're going to have to do a 180 because the challenge they face is you can't let the economy and the stock market go too much to the downside because you won't be able to bring it back. It'll take on a momentum of its own. It won't matter how much money you throw at it. It's just going one way. So they know that. And that's why, as I said, there's a reason history shows, not just modern history, but going back centuries, that whenever a government gets into a problem with debt, they rely on money printing. Well, they have to do it this time around as well, but sooner rather than later, because if they let this get out of control to the downside, they won't be able to get it back. So I do believe they're going to print again, but I think that'll be the last time. There'll be a final melt up in both stocks. I'm not so sure about housing, but you may see a higher high in housing. Gold and silver is just going to explode. But it's when, if we're going to jump ahead to next year, it's when people lose confidence in the dollar and the policies of the Fed and the US government sometime around mid next year, and they're printing, and the stock market starts to go down. They print more, and it keeps going down. Then it's game over because the Fed's now powerless. So what is it left for them to do? Pull the plug. It's not working. It's just creating hyperinflation. So we're going to have to pull the plug. Hence why I've been saying I believe the Great Depression starts next year. We see the peak next year, and then down we go.
So, David, what do you see as, let's say, the catalyst or the specific point that is going to force the Fed to turn to do that 180?
Well, look, there's several signals that I'm looking at. Falling inflation, we can check that box. It's only fallen 1 month. They probably want 2 or 3 to be able to justify, hey, look, we've done our job, it's working. Rising jobless and unemployment. That's another one. That's already started. We're seeing the jobless claims soar. Weak, even recessionary economy. That's a big one. Again, because they don't want this running away from them. A panic dump in stocks. We've seen an orderly sell-off pretty much since November. or January, depending which index you're looking at. And if we're getting this bear market rally now, it promises to be a good one. But what if the peak of this rally we're currently enjoying, we get a flash crash, or a 1987 like event, like the entire rally is erased in the space of a week? That will cause them to wake up. A dump in housing prices. If you see housing prices start to collapse, you see foreclosures skyrocketing, you see banks getting into trouble on some of their mortgages. I mean, 2005 all over again. Mm-hmm. That's another one. A blowout in credit spreads. That's another check the box. If you look at double B yields right now, they have exploded out relative to treasuries. So that's another check the box. And then the big one is some event. Look, the Fed never wants to take the blame for their actions. So they typically have cover. So I'll give you the prime example for me. Everybody blames COVID or the lockdowns for what happened in March 2020. It was the repo crisis that caused it. That was the Fed's fault. And that's why Powell had to do his 180 in December 2018, but it wasn't sufficient and it wasn't fast enough. So then March 2020 happened. The lockdowns and COVID was the cover for the reversal. So there may be some event this time around that they could use as cover. Look, much like they say the Ukraine invasion was the cause of inflation. Sorry, I'm trying not to laugh. But the Fed will want some kind of cover for the next 180. So what could that be? Monkeypox lockdowns, global cyber event, China invades Taiwan. I don't know, but I guarantee you, if any of those things happen, mm-hmm. you're going to see the Fed doing about turn. So my point is, I don't need all of these things to happen. Just a few of them, or one, even if it's a global event. But those are the signals I'm watching. But I will say this, I expect it to happen by September or October this year at the latest. I believe it'll come sooner than that. And why? Because September and October are typically the worst months for stocks. And if these guys are on a QT binge, plus interest rates are, they've maxed out on the interest rates and they're doing QT, in a market that needs liquidity to survive, never mind thrive. Mm-hmm. Once we hit September, October, that'll be the moment where I think they will have to reverse policy, because we could be 50% down in the NASDAQ at that point. Mm-hmm. But personally, I think it's going to be sooner than that. That's my latest forecast, but I think it's going to be sooner than that. But those are the key factors that I'm looking at with regard to the Fed, those several signals.
So as we've seen, some of the volatility come out of the markets here, this has aided the peak in dollar strength for now as demand is weakening. So do you kind of see it that way as well, David?
Dollar strengthening? Sorry, you lost me at dollar strengthening. So no, I want to say something about dollar strengthening. I really did get gaslit by that statement, and I'll have to ask you to ask me the question again. But I do want to make a comment on that. That's important. The dollar isn't strengthening. And how do I know this? Just look at oil. Just look at gold. Although it's come off, it's still in the mid 1800s. We recently nearly tested the record highs. Look at the prices of everything. Housing's went through a boom. It's finally starting to come off thanks to the Fed. Look, if the dollar is being devalued 50% and the euro is being devalued 60% and the yen is devalued 80%, they're all being devalued. It's just the dollar is being devalued at a slower pace than everybody else. So the dollar euro is going up. The dollar yen is going up. The Dixie is going up. So what? But gold's going up as well. So gold is telling you, and this is why it's been suppressed for so long, is telling you what's really going on. It's exposing the devaluation of all fiat currencies, including the dollar. It's just the dollar is being devalued at a slower rate than the rest. They're on a tightening binge right now in the US, whereby the ECB is still, and especially the Bank of Japan, are still loosening. But the ECB is getting ready to turn the corner, and it sounds like Japan may be starting to think that too, at least scaling back their QE. At the same time, I'm waiting for a Fed 180. What do you think is going to happen to the dollar when that happens? See ya. Mm-hmm. Look out below. And I've been saying that, and I may have already peaked, but I don't think so. I think we haven't gone into things like technicals and so forth. But the dollar may have one more shot higher. Now, people say 120, and yeah, it could get there. But I'm thinking of a marginal higher high. But yeah, it could go much higher. But I don't think that's going to have a huge impact on gold, because gold's already come off, and it could go lower, but it feels like it really wants to take off, especially when you see all the fiat currencies being devalued. And that's what makes this Fed 180 so important, because much like March 2020, when the Fed throws in the towel this time around, it's the last hurrah. And they're going to print trillions, and gold's going to go ballistic. And if that, if you can imagine the gains that will have, just think about what silver's going to do. I mean, silver has gotten trounced. But anyway, no, my point is all fiat currencies today that I'm aware of are being devalued. Mm-hmm. It's just they're being devalued at different rates right now. And we know this by looking at all those currencies relative to the likes of gold and oil and commodities. Look what's happened to commodities in the past year. So I'll ask you to ask me your question again, unless I probably already covered it. I don't know, because I got lost. I got tied up on dollar strengthening.
Yeah, I mean, it's kind of a bigger discussion that I want to have about the dollar. And, I recently heard you speak on an interview with Craig Hemke about China announcing their official gold reserves, maybe, as they are, only an importer and not an exporter of gold. So what would this do to the dollar in that scenario? And is there a particular time that they might want to deploy that strategy?
Yeah, well, that's just one trigger for the dollar's end as a global reserve currency. I was basically pointing out in that interview that China massively understates its gold holdings. They publicly state it's somewhere around 1,800 tons. That's complete and utter nonsense. I think it's closer to 20,000 tons, in my opinion, more than double that supposedly in the US. If that were to happen, look what happened to the ruble recently when Russia said that they would take a fixed price of 5,000 rubles per 1 gram of gold. What happened to look at the dollar ruble since they made that announcement? Mm-hmm. And they backed off to it 2 days later, but the people got the message. The dollar ruble has just the dollar has weakened against the ruble. The ruble's been doing this. Mm-hmm. It's been going up. And that was just because they said they were pegging the ruble to gold. Now they walked it back 2 days later, but the effect is still there. Can you imagine what would happen if China said, we have 20,000 tons of gold tomorrow? I don't need to say any more. I mean, because in a world where all currencies are being debased, those with the commodities, be it oil, the petrodollar, gold, to back their currency, those currencies are going to outperform those that have literally nothing to back it. And here's another one. If the Saudis end the petrodollar, in other words, they're willing to take payments in other currencies than the dollar, and they're willing to price their oil in other currencies than the dollar, say the yuan or the ruble and whatever, that's the death knell for the dollar as well. Mm-hmm. Look, in my opinion, and I don't want to get into the details on this too much, but I've been saying it loud and clear. The dollar has been scheduled for demolition. And the reason is they want a new supranational currency. Like China doesn't want to have the global reserve currency. Russia doesn't want to have the global reserve currency, because you have to run massive current account and budget deficits if you're responsible for the global reserve currency, because you have to supply it to the rest of the world so they can use it as reserves. So nobody wants it. So what's the answer? They're going to create a supranational one, a basket of currencies. Well, what would that look like? Well, it's already here, the ESDR, or the SDR, but I'll call it the electronic SDR, or the digital SDR, special drawing rights. But in order to roll out the SDR, you got to take the biggest guy out of the question, and that's the dollar. So I think the dollar is scheduled for demolition. And I was just saying that China could do that in response to, say, China invades Taiwan. That'll be a very significant moment, because if the US responds with sanctions, maybe China doesn't send over a missile, they win a war of attrition basically by not firing a bullet, but announcing that they've got 20,000 tons of gold. Mm-hmm. Sorry, we said it was only 1,800, but it's actually 20,000. Sue us later, And in the meantime, Saudi announces, we're no longer sponsoring the petrodollar. We're going to price our oil in a basket of currencies, also hinting at a new global reserve currency. So I think there's a whole number of factors that could push the dollar way much lower. But a Fed 180, that's the one I'm focused on. Those other ones are possibles, but are they probable in the short term? No, but there are events like an invasion of Taiwan that could trigger such an event.
Mm-hmm. So really, China could just enter into financial war against the US without, like you say, firing a bullet.
I would argue that they're already doing that. They announced there a couple of weeks ago that all politicians that are high in the government over there have to divest themselves of US assets. Who knows how much they own? But the Chinese in general, it's a slippery slope. The Chinese in general have been big investors. We know this in Canada, in the real estate here, but in businesses, land, they've been buying miners all around the world. Gold miners, silver miners, copper miners, South America, in Africa, and so forth. They got their Belt and Road Initiative and so forth. If they pulled all that money back, what Buffett said, we'll know who's naked when the tide goes out, right? Mm-hmm. So there's lots of things they do, but I would argue they're already doing it. But now you're at the moment, you're like firing arrows from a bow. We're talking about taking a bazooka out next when you're talking about announcing 20,000 tons of gold.
Mm-hmm. So do you think that starts to bleed into the foreign held US Treasury markets as well, and that starts to create a landslide?
Well, it could. I think the horses bolted on that one when the US stole Russia's 300 million odd of FX reserves. Mm. And that sent a message to all other currencies. Look, the global reserve currency, the reason why they keep it in their accounts is it's a safety mechanism. But if a crisis hits and you take that, the US government can literally take that money back with no compensation for it, then why would you keep it? Like, why, if gold's supposed to be a safe haven in a crisis, but then someone can simply take it away from you, why would you buy it? Mm-hmm. So again, the horse is bolted on that with regard to the US taking Russia's foreign exchange reserve, sent a message to China, India, and every other country in the world that hold FX reserves. And the writing on the wall began, I think, somewhat with Venezuela. But the fact that central banks all over the world are piling up on gold says it all, in my opinion, because I've been saying since 2016, follow the smart money, and my concentration was in China and Russia. But I also noted that Germany demanded its gold back, didn't get it for 3 years, and then finally the US sent it over. Why did it take 3 years? Mm-hmm. What, you didn't have it and you had to buy it? Anyway, I won't get into conspiracy theories, but my point is central banks around the world have either been loading up on gold or repatriating it. And even Ireland's doing it. Poland's doing it. Hungary's doing it. Everybody's doing it.
Mhm.
Why? Why? They're not buying Bitcoin. They're buying gold. Why? And they're selling treasuries. Why? What's coming? I mean, this isn't rocket science, Tom. It's if these guys, all the central banks, the power brokers on the financial stage are buying gold, you should be buying some too.
Mhm.
Personally, I prefer silver, but definitely have some gold.
Mhm. So you mentioned the housing market a couple times, David. So with the looming recession and after seeing these red hot housing prices, do you see the risk of a housing market collapse as dramatic as what we saw in 08?
Yes, it's certainly a risk, and that's what I said earlier. I think the Fed is watching that very closely because if the housing market crashes, confidence will be eroded dramatically. Demand will plummet. I don't think there's any coming back from that one because it's been in a boom here in Canada. I moved out from the city to a rural property, and in the space of 1 year last year, my property went up 50%, and that's insane. But we've been seeing, and since 20%, 25% increases. Now, the last 2 months, it started to go the opposite direction. To answer your question, the Bank of Canada is scheduled to raise interest rates again by 50 basis points. And we're seeing people with variable rates seeing their mortgage payments almost double in the space of
Imagine
a couple of months.
that.
Yeah, and those people who wanted starter homes and were trying to get something perhaps that they couldn't necessarily afford, but they wanted to have a nice home. So they had their target spending amount and they go a little bit over it. So they're right on the breadline with regard to the mortgage. How are they going to handle a 50% to 100% or even 200% increase in the mortgage payment? We're already seeing foreclosures going up. So I think this is a recipe for disaster in the housing market. And the Fed will be watching that one too. But to answer your question, I believe it either crashes this year, but if it doesn't, if we get the Fed does a 180 in time and we get another pop next year, that's the end. Game over. I'm on record for saying I think housing's going to go through, when the Great Depression starts next year, mid to late next year, maybe 2024. When that begins, housing's going to get crushed. And if you go back to the 1930s, and I always like to cite Benjamin Roth's book, The Great Depression, a Diary, where he described what happened there. Houses went to near zero. You could buy a McMansion in Connecticut for $1. And at auctions, foreclosure auctions, there was one bidder for every 100 properties back then. People were bulldozing their houses so they wouldn't have to pay the property taxes, because property taxes went through the roof because income taxes disappeared because everybody was unemployed. Corporate taxes disappeared because everybody was losing money. So property taxes went through the roof. So people were bulldozing their houses and like living in tents on their land. Could that happen again? Yes. We haven't had we had 2008, but it was confined to the housing market. The housing market and the stock market had a pullback, but the housing market took the brunt of it. And then we had the 2000, it was the dot-com bubble. And then you had 1987 prior to that. But we've never had, allowed a recession to run out. The Fed's always stepped in. So you blow up a balloon and then you let a air out. Then you blow up the balloon even more, then let a little air out. And then you blow up the balloon. Eventually, when this thing bursts, it's going to be a disaster. And that's why I believe that we've got a depression coming. So I won't ramble on. I'll just say housing either this year or next. That's why I've sold all my properties except for my off-grid one, obviously. I'm talking to you in a rental property right now. So I'm putting my money about where my mouth is, basically.
Mm-hmm. So, David, since it was over a year since the last time we spoke. Have you made any changes or additions to your FIPEST XM process?
No, it's still the same. The only change I've made is the emphasis. So the fundamentals, which I'm not talking about the economy, I'm not talking about the latest inflation numbers. For me, the fundamentals, given that these markets are centrally managed, is the Fed, and to a lesser extent, geopolitical events. So that has taken a bigger emphasis in my process, because as you've seen with, I made an oil call recently where I was talking about shorting in the 80s and stopping out at 100, and it went up to 130s. And the reason for that was the Ukraine invasion. So there's a geopolitical event. But when it was at 85, the COT positioning showed that the banks were short. Sentiment was ridiculously high. It was extreme overbought. So everything said it should go down. That's what my FIPEST process says. But it still went up another $40 because the fundamental reason hit it. So I still use the process, and it works extraordinarily well, in my opinion. But the emphasis has switched a little. It used to be like, if you look at gold from 2015, actually gold has actually held pretty well. 2015 to 2022, this year, whenever you see sentiment extremes, the only time it's broken down, cut a long story short, the only time it's broken down was in 20, when the trade war was on. We had by May extremes in oversold indicators in the technicals. It was extreme bearish. The funds were heavily short, and the banks were heavily long, and it kept going down. It didn't bottom until what was it, September, October, because the fundamentals took over. So that's the only change to the FIPEST process. It's a greater emphasis on the F than there was before.
Mm-hmm. So I guess just to summarize, do you think we're at basically really close to a bottom here for the metals, and then we're only waiting on the Fed to turn around and make an about face here?
Absolutely. The COT data is extremely bullish in gold, and especially in silver. I just looked this up today. The banks are long silver and the funds are short. Let me repeat that. The banks are long silver. They've been incredibly short for the past couple of years, and now they're long. And when they were at their peak short, that's when we got the peak in silver, and now they've managed to get out of those shorts, and now they're long. The reason why that's important, the last time that they were long was in June of 2019, when silver had a $14 handle. And now it's still in like the low 20s, but it had a $14 handle. Now, could they get could they get longer and the funds get shorter? Absolutely. So it could continue a bit lower. But the technicals tell me that either we've hit a bottom, because we, like various reasons, we've hit a bottom in both gold and silver and the miners, obviously, or we've got one more positively divergent lower low to come. And that would be around 19 in silver and just below 1780 in gold. And then it's launch time. The only caveat I have to that, and why I think a lower low is possible, is the sentiment is still relatively buoyant in gold. People they haven't thrown in the towel, they haven't capitulated on gold. Mm-hmm. Now, I could be wrong, and I'm not going to hang my hat on one indicator. I look at all of them. But, gold is not exactly bearish. Silver, on the other hand, got hosed recently. Could it take one more dip? Yeah, sure. But gold will lead on the way up. It always does. But silver is going to go bananas. So to answer your question, you've got the Fed 180, which is what I'm watching. I mentioned all the signals that will trigger that. Some of them are already checked the box. Some of them have to be still have to transpire. But so we're waiting on those. But if you're looking at positioning and you're looking at technicals, the bottomism, the conditions are in place for a major low here. And let me say this loud and clear, and I've tweeted it. We're in the mid 1800s on gold. We've been down to the 20 handle in silver. The worst is behind us. Mm-hmm. Could we go a little lower? Yes. But the risk reward is massively skewed to the upside. We're far closer to the bottom than we are to the next peak. Mm-hmm. And I want to get this message out to your listeners. If you don't have any physical metals whatsoever, I recommend that you buy at least some here around these levels. I'm not telling you to go whole hog, just buy some. Because in my opinion, from here, we're going to go to new record highs in gold, perhaps silver, but I'll take $40. GDX could hit new record highs too, but I'll take a 60, give or take. But it's going to go ballistic. Then we'll get some pullback after that. And then it's gone. My point is you may not see these prices ever again once we hit the low here. And we've gone almost 2 years. We've gone from 2089 all the way down to 1675. Silver's gone from 30 down to 20. We're just biding our time here. And as I said, I believe it's going to be September or October when the Fed 180 happens, or before. Now, you can try and pick the last few pennies and wait till the end. If you want to be really confident about buying it and you don't mind missing out on the few pennies to go, wait for a bottom, a higher high relative to a previous high, then a higher low relative to the previous low, and then another higher high. Because once you get that a series of higher lows and higher highs, the trend has changed to the upside. And there's plenty of gains thereafter. If you want to be confident that the low is in, that's what I recommend you do. But I think the downside is relatively limited from here. Could we have a sharp drop in coordination with the stocks? Sure. But if you get that, it's a gift. And I would buy it with both hands. But that's just me. I'm already long, but I recommend people to use this opportunity to buy at least some. It's an insurance policy given what potentially could transpire in the future. And I'm not talking about financially, I'm talking for your whole lifestyle.
Right. Yeah. And it would be interesting to think about, I guess, what could happen to premiums at that point too. If demand starts to pick up, you could be missing that those few pennies that you were so worried about and paying them in premiums, which is pointless as well, right?
Yeah, and I'll make a comment that it could be even worse than that, Tom. Imagine there's none available. You can't find it anywhere. It's been vacuumed off the market. By the time it turns and you wait for that higher low and higher high, and you go to call a broker, I'm out. It's gone. Oh, that'll never happen, David. March 2020, it was extremely difficult. People were buying it on eBay for extortionate prices. Could that happen again? Yeah. And the premiums today are still extremely high. That should tell you something. Thanks for bringing that up. The premiums, like if you go out to buy a silver coin, it's still around $10 above the spot price. Right, we're down at 20, and I still have to pay $30 for it. Some cases, maybe $7.28. If you get it, like you call one of the bigger shops, you'll get a better price. But they're still extremely high. So to your point, when this starts to take off, those premiums are going to blow out. Blow out. And if this Fed 180 is caused by something that hurts supply chains, like say we got a monkeypox lockdown, just for argument's sake, I don't believe that's going to happen, but let's say that is what causes it. Supply chains are going to be even tighter. I mentioned that the refineries in Switzerland were shut down due to COVID.
Mhm.
That was a huge impact on premiums. I mean, where's the supply of gold and silver going to come from if the refineries are shut down? So, and with regard to silver, there's a couple of reasons why many why I think it's going to outperform gold. It always has in major rallies. It's a smaller market. It's gotten hosed recently, but silver is a byproduct. The mine, from a mining perspective, you don't go to there are very few pure silver mines in the world. It's usually like you're mining copper. Oh, and look, I found some silver. So what happens if we do get a Great Depression and all these mines are shut down because nobody needs copper anymore? The world's gone down the toilet. Where you're not going to be able to get any more silver. But gold mining, still has a business, and there might be some silver there too, but the supply of silver will fall even more than gold. So silver will vastly outperform gold going forward when this takes off. That's why, and the other thing about it, it's the poor man's gold, because right now gold's at to buy 1 ounce, it's $1,800 Up here in Canada, it's a good deal more. And that's not including the premium. But if you look at silver, it's $20 US according to the futures. It's somewhere closer to 30 if you actually go to buy one. You can buy a lot more of those. And for those who have not got the means to buy the big numbers, that's their easy way to get some precious metals. That's why it's called the poor man's gold. When they go into the bank manager and say, hey, I want to buy, 10 ounces of gold. All right, that's 100,000, or what is it? It's going to be $20,000, say. And they look at, wait, what? Sorry, 100 coins is 200,000. 10 was 20,000. What else can I buy? Well, I can buy silver.
Mm-hmm.
So that's why I believe if you're short on money, but you love what you're hearing and you agree with what I'm saying, you can always try buy a little bit of silver. And you don't have to go out and buy a lot in one go. You can just buy like a few coins every week. Mm-hmm. But you are absolutely correct. When this thing starts to go, premiums will blow out. My worst case is you can't get it. Mm-hmm. It's gone. There's none available. The mines are shut down. The refineries are shut down. And those who have it are sitting there just eating their popcorn, watching the price go through the roof.
And
I will be.
Yeah, we've already seen that there's still mints that can't get blanks at this point.
Yeah.
2 years after the supply chain supposedly got so wrecked, right? So it's not a problem that has gotten dramatically better since that time.
Yeah, and if the world is going into depression and the powers that be are going to try and use green energy to pull us out as a job creator and to provide incomes to people, well, that's going to mean a lot of solar panels. And what do they use? Well, the most of them use silver in their production. So silver could go absolutely ballistic, especially when the gold silver ratio was recently back above 80. Gold's going to go up. Silver's going to go even more so. Back in the 1970s, gold from 1974 to 1980 went up 24x. Silver went up 37x. From 2000 to 2011, gold went up 8x. Silver went up 12x. There's precedent for why silver will cream gold in the next rally. Mm-hmm. And those are percentages. Well, you see the dollar numbers. So, and it's easier to access than gold. So I think the same thing's going to happen this time around. The one thing I will warn your listeners about is the miners. The miners will explode beyond belief. But the one thing you got to remember with miners is you have to get out at the right time, because there is a risk that they could get nationalized, because it's going to be a extremely important resource for every country around the world. And even if you get out at a good level, you're getting paid in rapidly devalued fiat currency. Is that really what you want? Mm. Whereas with the metals, you have it in your hand. So just keep that in mind. Miners will vastly outperform gold and silver, certainly in the short term, a matter of years, but your payout is in fiat currency, and it may be capped at some point in the future, or even taken away from you because it's been nationalized.
Mhm.
Just something to think about.
Mhm.
The
Excellent
best,
point.
the best thing people can do is, I would say, to the extent that you want to have exposure to this sector, I would put more money in metals. But if you want to take a bet, or you want some juice to your portfolio, put like 10 to 20% of it in miners. But the vast majority of it in metal. They will go up big too. But miners, I can only imagine what Silj is going to do, the junior silver miners.
Mhm.
Um, so I think that's going to 25 to 30 on this next rally, from where was the recent low, 10. And that's just the next peak. I won't tell you where my forecasts are for the years out.
Excellent, David. Well, it's always good to get your perspective and see how you're analyzing and looking at all these different markets. Of course, you're very active on Twitter at Global Pro Trader, and you post a lot of your content there. And tell everybody where else you write for.
Yeah, sprottmoney.com. You can find me there, and I'm a contributor to silverchartist.com, or Silver Chartist Pro. You can find me there too.
Excellent. Thanks so much for your time and coming back to give us an update, David. Really appreciate it.
Thanks very much, Tom. Thanks for having me on. It's been great.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.